Okay, so this we're gonna go through. So we talked about starting basis, how we calculate our starting basis, but that's just our starting point. Basis changes all the time in a partnership. So if an individual sells their partnership on June 1st, we have to determine what their basis is in that partnership on June 1st to determine how much gain or loss they would have on that partnership. We also need to know what the basis is to determine whether or not any amount of distributions, remember distributions on that K1, we had 26,000 in that previous K1 that we just looked at, whether or not any of those distributions are taxable, whether any tax has to be paid on those. So also, if our partnership experiences a loss, so if box 1 is a negative, so we had more expenses than we had income, in order to determine whether or not we get any tax benefit from that loss, we have to have basis. So if we have a loss, we've got to determine what that basis is. Otherwise, we don't get to take the loss. It gets suspended, what they call it. When we get rid of the partnership, and when we have any distribution. So those are the three main times that we have to have that basis. But in order to get an accurate basis, we have to keep a running total. So we can't just wait until 3 years down the line, we experience a loss, and then we've got to do the calculation of whether or not we have any basis. We've got to keep going, we've got to keep it up on a continuous basis. All right, so what increases and decreases basis? Remember, when we were talking about assets, and a partnership is an asset, when we were talking about assets, improvements would increase our basis, depreciation would decrease our basis. Well, we don't depreciate a partnership, right? It's a different type of asset, but there are certain items, certain events that happen that will increase and decrease our basis. Here's the calculation for it. So we have our starting basis, which we know how to calculate. At least we could look at the chapter and figure out how to calculate that starting basis. Remember, it's the basis of our property contributed, basis fair market value of any services rendered, and that property contributed could be cash or could be in some other form as well, whatever that is. Plus, any amount that we contribute after our beginning. So if we began our partnership in January and then in October we're going to contribute some more money, well, that increases our basis. That subsequent contribution of funds will increase our basis. Plus the partner's share of ordinary income. The partner is going to pay tax on that ordinary income. Whether they received any money out of the partnership or not, they will pay tax on that. So the previous K1, I don't want to go back because otherwise I've got to walk back and forth. So that K1 that we just saw that had what, 60,000 some change of ordinary income, but $26,000 of distribution and $42,000 of guaranteed payments, the partner is going to pay tax. Well, let's pretend they didn't have the $42,000 of guaranteed payments. They just had $60,000 of ordinary income and $26,000 of distributions. They're going to pay tax on the $60,000, even though they only got $26,000 out of it. They're going to pay tax on the $60,000. That means that whole $60,000 gets to be added to the basis, so it's not going to be taxed again because they've already paid tax on it. And that's quite common for partnerships, especially in the beginning stages, is that partners will have to pay tax on income that they didn't even receive. So, partner share of partnership ordinary income plus partner share of separately stated income or gain items. So the capital gains, the dividend income, all of that stuff adds to the basis because they're paying tax on it when they get that K1. So when they actually pull it out or when they sell their share, they're not going to pay tax on it again. Plus, the partners share in any partnership liabilities. So if the partner is responsible for any of the liabilities of the partnership, then that increases their basis as well. Now, things that decrease basis. Basis of any property distributed. So any amounts that were, any cash that was distributed or any property, whatever that fair market value of that property is, the basis of that, but not below 0. Remember, you can't go below 0. If you get to 0, then any amount over and above that, you're going to have to pay some tax on it. Less the partner's share of partnership ordinary loss. Again, not below 0. Less the partner's share of separately stated loss or expense items. So that 179 expense, and by the way, that's whether or not you could use them. So if there was a charitable contribution that you couldn't use, so the partnership made a charitable contribution, you don't itemize your deductions, so you don't get any tax benefit from it, but it's still going to reduce your basis in that partnership. Also, the release of any partnership liability. So if you're no longer responsible for any of the debt of the partnership, that then reduces, that you were responsible for prior, because it would have increased, any amount you're responsible for would increase it, any amount you're no longer responsible for would then decrease it. The basis that remains is what's used to determine any deductible losses from the partnership. So you do all of that calculation, and then you can see, okay, do I get to take any of this loss? And what losses do is it offsets other income on your tax return, right? So if you have $100,000 of W-2 income, and you got a $50,000 loss in a partnership, that brings your, and you can take all of that loss because you've got basis in the partnership, that brings your taxable income down to $50,000. So it will offset other income on your tax return, but only if you have basis. So let's take a look at an example here. We've got Allison. So she had a basis of $5,000 at the beginning. So she must have, maybe she contributed something worth $5,000, maybe it was cash, maybe she provided services, and when she did that, she had to pay tax on her services that were worth $5,000. So tax has already been paid on that income when she received it. Her beginning basis is $5,000. Ordinary income is $2,500. So that box 1 on her K1 is $2,500. She received $3,000 out of the partnership. So she got a check for $3,000. And then she also got some land that was worth $4,000 at a fair market value of $4,000. All of those, so beginning basis plus income minus distributions equals our year-end basis of 500. So if next year there is a loss, if she doesn't do anything else, if next year is a loss, she can take up to $500 of that loss, as long as her basis continues to be at that 500. So, but when she takes that loss, that brings her basis down to 0. Okay. All right. So the K1 that we saw before, again, that 10,600 wasn't on there. Our beginning basis 22,000. Ordinary income box 1. 60,540, that gets added. Dividends that we're paying tax on, 1,110. Capital gains, short and long term, 1030 or 1231 gain. Minus, okay, so box A was charitable contributions. $2,600. Again, it doesn't matter if they don't itemize, they're not even going to get a benefit from that, but it's still going to reduce their basis. And then the 179 expense means their ending basis is $71,595. So remember, they got a distribution of $26,000, right? That means that none of that distribution is taxable. Guaranteed payments are not used in the basis calculation. The reason being is they're getting a deduction for those guaranteed payments, but then they're also paying tax on it, so it's in and out. It would increase their basis, but then it would decrease their basis, so we don't have to worry about doing anything with it because it zeroes out. All right, liabilities. So liabilities, we only, remember it said up here that any of their partnership liabilities or release of liabilities would be included in the basis calculation. We do that last, though. We don't consider it unless we get to the point where we're in negative basis territory. Yeah.
So the calculation includes the distributions, but that doesn't. Why?
I don't know.
Okay.
I don't know why they didn't include that.
So the 71,595 should be $26,000 lower
It should,
for the basis.
it should be.
Okay.
Yes. Well, and I guess we can use this to determine whether that any of that $26,000 distribution is taxable to him. So we do this first,
Okay.
then we'll do the distribution. So yes, it will reduce it, but we do this first so that we know how we treat that 26,000.
Okay.
But great question. So the liabilities we do at the end. So the liability level of the partnership is consistently changing, because you're paying off debt, like you're making monthly payments toward debt, and then it's all the time. Usually that calculation, as they say here, isn't necessary, but if we need to do but we keep track of it at least at the beginning of the year and at the end of the year, in case we need to use liabilities in our calculation. So in this case, the liabilities were shown on that K1. I'll go back to it in just a second here so you can see. It was shown on the left side of the K1. Ending basis 71,595. After we've calculated it up here, they call it ending basis. I suppose it is ending basis. The next part of the calculation, we would then include the liabilities. And don't worry about recourse, non-recourse, just has to do with whether or not it's backed by any particular asset, or if it's, like if they declared bankruptcy, could the creditor go after any hard asset or not. So in this case, his ending basis, total basis would be $140,895. We would only do this calculation though if, let's just say we did this calculation and he had $75,000 of distribution. Then we'd have to do this other calculation to see if he has enough basis, but then what that does is it reduces his basis in the liabilities. Also, so the sequence to the basis adjustments, aside from the liabilities, increase and decrease by all adjustments except for losses, reduce it by money distributed, including the release of liabilities, and then reduce it by the basis of any property distributed. So there is an order to that. Questions about, so the main point that I want you to get out of this is this calculation, this shaded area. Things that increase and decrease basis. Questions? No? Okay, so I'm gonna go back real quick to that K1 so I can show you where those liabilities are. So right here. Now in this case, their capital account is not the same as their basis because they started at 22,000. But you can see in their capital account, it also is adjusted by income, so 64,755, which would be the 60 plus these items, I guess. Minus the distributions. I don't know why that's. 755, 115, I'm curious now. Current year net income or loss, 64,755. Oh, wait a minute. Still 60. Alright, well. I don't know where they get that. But that's where, so, anyway, I'm distracted. So this is where the liabilities come in. Shows you the beginning liabilities, partner share of liabilities, ending. This is not the total liabilities for the partnership, it's just the partner share of them. And we'd only use that at the very end if we needed, our basis had dipped below 0, then we can dip into that basis. Okay? Kelsey?
I'm so lost. I'm not gonna lie. Because like, if you look at, so if you go to that, the box with the calculation.
Oh,
Mm-hmm. And then, and then you scroll down to the 71,595.
mm-hmm.
If you scroll down a little bit more, the calculation says to subtract your liabilities.
No, you add your share of the liability. So the calculation is plus the partner's share in the partnership liabilities.
Oh,
You would subtract it if they were released from any of those liabilities.
okay.
So if they no longer had responsibility for them.
Okay.
Okay?
Yep.
Other questions?